Credit card companies have a multitude of methods to keep you in debt and paying them money. So before you get your first credit card and fall into debt, we're going to answer the most important questions about credit cards so you know exactly how to protect yourself from overpaying. And on top of that, I'm going to reveal 2 mistakes new credit card applicants make that get them in the debt trap. First, what's up with credit cards having hidden fees, and more importantly, how do we spot them? So understanding the fine print really can be daunting. Credit cards have a variety of fees that won't immediately be obvious. Just being aware of what these are and knowing how to spot them is the key in choosing the right card and avoiding unnecessary charges. Let me tell you, there are so many kinds of fees: annual fees, late payment fees, balance transfer fees, advance fees, foreign transaction fees, over the limit fees, return payment fees, and activity fees. In theory, one would just read the terms and conditions of the credit card. But if we come back down to reality, who does this? So the more actionable advice is to look for the Schumer box. Let me break it down. Credit card companies must, by law, include a Schumer box when offering a credit card. It's a clear and concise table that lists fees, interest rates, and other costs. It makes the jargon plain. And if you're unsure about any of the fees, directly ask the credit card company about them. Remember, while some fees are standard across many credit cards, others can be avoided by choosing the right card and using it responsibly. Being informed and proactive is the key to navigating credit card fees effectively. Now let's move on to the 3 most important letters you need to know about credit cards. What does APR really mean, and how is it calculated? APR stands for annual percentage rate, and it can be a confusing concept, especially with different types of APR for purchases, cash advances, and balance transfers. APR, or annual percentage rate, is a key concept in understanding the total cost of borrowing on credit cards and other loans. It represents the annual cost of borrowing money, including interest and other fees. It's expressed as a single percentage number that represents the actual yearly cost of funds over the term of the loan, or put plainly, the total cost of borrowing. And it includes any fees or additional costs associated with the transaction. The APR is primarily based on the interest rate, which is the cost of borrowing money on the principal balance. If there are other charges involved in obtaining the credit, like an annual fee, these are factored into the APR to give a more accurate cost of borrowing. There are also various types of APR, like fixed, variable, and introductory APR. Fixed APR remains the same over time. Variable APR can change based on index interest rate, like the prime rate. Introductory APR is the promotional rate offered for a short period. Understanding APR helps you compare the true cost of loans and credit cards. A lower APR will mean that you'll be charged less in interest, assuming you pay the same balance in the same manner. For credit cards, the APR is usually divided by 365, the amounts of days in a year. This rate is then applied to your daily balance to calculate the interest charges. Remember, the APR is a helpful tool to compare different credit cards or loan offers on a level playing field. It's essential to look at the APR, not just the interest rate, when considering the cost of borrowing. Up next, can you negotiate a lower interest rate on your credit card? Many people don't realize that they might have this option. Of course, you can try to negotiate a lower interest rate on your credit card. Many people aren't aware that credit card interest rates are not set in stone and often can be negotiated. Here's how to approach this. Step 1. Understand your current standing. Before you call your credit card company, make sure you're in good standing. This means that you've been making your payments on time and you have a decent credit score. Companies are more likely to negotiate with customers who have a strong payment history. Step 2. Research other offers. Be informed about what other credit card companies are offering. If you find cards with lower interest rates, you can use these as leverage in your negotiation. Step 3. Call their customer service. Reach out to your credit card issuer. Don't hesitate to ask for a supervisor or somebody in a position to make changes to your account if the first representative can't help. Step 4. Present your case politely and firmly. Explain why you deserve a lowered rate. If you've been a loyal customer or have good payment history, or your credit score has improved since you got the card, mention these points. Also, reference better offers from other companies as part of your argument. Step 5. Consider a balance transfer. If your current issuer won't budge, let them know you're considering transferring your balance to a card with lower rates. Sometimes the threat of losing a customer can motivate a company to make a better deal. Step 6. Be prepared to walk away. If they don't meet your needs, be prepared to switch to a credit card with better terms. Just ensure you understand any fees associated with any new card. Step 7. Negotiate again in the future. If they say no, it doesn't mean no forever. Your financial situation and the credit card market can change. It's reasonable to ask again in 6 months to a year. So remember, not every attempt at negotiation will be successful, but it's definitely worth a try, especially if it can save you money on interest in the long term. Credit card companies value retaining good customers, and if you present a strong case, they might be willing to lower your interest rate to keep your business. Can using my credit card too often hurt my credit score? Understanding the balance between use and overuse of credit is the key here. Using your credit card frequently doesn't inherently hurt your credit score. In fact, regular use can be beneficial as it demonstrates you can manage credit responsibly. However, how you use the card and manage your credit account is what really matters. Credit utilization ratio is a major factor in your credit score. It's the amount of credit you're using compared to the total available credit. High utilization in credit card terms isn't really what you would consider high in real-world terms. In credit card terms, it's generally anything above 30%. Lenders interpret this to mean that you're overly reliant on credit, which can have a bad impact on your score. So if frequent use of your credit card brings your utilization ratio above 30%, it could indeed lower your score. Another critical factor is your payment history. If you're using a credit card often but are paying the bill on time and in full each month, This will positively affect your credit score. Late payments or paying less than the minimum amount will harm your score. Is it bad to pay off my credit card balance right away? There's a common misconception that carrying a balance is good for your credit score, but paying off your credit card balance right away is generally considered good practice, not a bad one. Here's why. First of all, it avoids interest. Credit cards typically have high interest rates. By paying off your balance quickly, you minimize or avoid interest charges and save money in the long run. It also improves your credit utilization. Credit utilization is the ratio of your credit balance to your credit limit and is a key factor in your credit score. Keeping a low balance helps maintain a low utilization rate, which is beneficial for your credit score. Paying off your balance also reduces your debt burden. This is especially important if you're budgeting or trying to maintain a disciplined approach to personal finance and growing your wealth. There's also a psychological benefit in paying off your credit card quickly. It can reduce stress knowing you don't have any lingering debt. However, there are some nuances to consider, like if your credit card has a grace period, the time between the end of your billing cycle and the due date for your payment. You won't be charged interest if you pay your balance in full by the due date. In this case, you could hold off on immediate payment until the due date without any extra charges, and sometimes it might make more sense to keep cash for other urgent needs. So paying off your credit card balance right away, typically a good thing for both financial health and your peace of mind. It helps you avoid unnecessary interest, keep a good credit score, and manage your finances more effectively. Why was my credit card application denied? People often feel ashamed to discuss credit rejection. If your credit card application was denied, it's disappointing and confusing. There are several reasons why this might happen, and understanding these reasons can help you address any underlying financial issues. The most common reason for denial is a low credit score. Often it's due to past payment issues, high credit utilization, or a lack of credit history. Credit card issuers want to see that you have enough income to manage your credit line responsibly. If your income is too low or you didn't provide enough proof of income, they may also deny your application. Also, if you have a lot of existing debt compared to your income, or a limited credit history, your application may be viewed as high risk. Applying for several credit cards or loans in a short time can also be a red flag for issuers, mainly because it might indicate financial distress. It's also important to be aware of what's on your credit report. Sometimes a denial might be due to errors on your credit report. It's a good idea to check your credit report for inaccuracies. If you're currently unemployed, issuers might be concerned about your ability to repay the credit that you borrow. In many circumstances, you need to be at least 18 to apply for a credit card, and applicants under 21 often need to show independent income or have a cosigner. So let's make this real. What can we do if we're denied? The first thing is to understand why. The credit card issuer will send you an adverse action letter explaining why you were denied. Review this carefully so you know the exact reason, then work on paying down existing debts, making payments on time, and keeping your credit utilization low. Look for errors and dispute any inaccuracies that you find. Applying for a more suitable card may also be helpful. If you were denied for a card with high requirements, considering applying for a card designed for lower credit scores, like a secured credit card, and give it some time before applying for another credit card, especially if you've had multiple recent credit card applications. Remember, a credit card denial isn't a reflection on your worth as a person. It's an opportunity to reassess your financial habits and take steps to strengthen your financial standing. You're already on the right path by spending your leisure time watching videos like this, right? These last 3 questions are critical for staying out of the debt trap. Most people don't even ask these hard questions and pay the price financially for it. What should I do if I can't make my credit card payment? So this next one is a tough situation many people run into and are often too embarrassed to ask for advice on. If you find yourself unable to make a credit card payment, it's important to address the situation proactively and responsibly. Firstly, let's address the problem. Ignoring missed payments can lead to late fees, increased interest rates, and negatively impact your credit score. Acknowledge the issue as soon as you realize you're going to have trouble paying and take a close look at your budget. Identify any non-essential expenses that you can reduce or eliminate, at least temporarily, to free up some funds. Then reach out to your credit card company as soon as possible. They may offer hardship programs or temporary relief options like payment deferrals, lower interest rates, or adjusted payment plans. Make sure to ask for specific programs about customers facing financial hardship. And if you can't pay the full amount, try to at least make minimum payments. This can help you avoid late fees and mitigate the impact on your credit score. Non-profit credit agencies can also offer advice on managing debt, budgeting, and working with creditors. They might be able to help negotiate with credit card companies on your behalf. If you have multiple debts, make a priority list. Typically, secure debts like mortgages or car loans should take precedence, but keeping credit card debt in check is also important. Also, try not to use your credit card further until you've caught up with your payments. Adding more debt will only make the problem worse. If possible, find ways to increase your income like taking on part-time work or selling items you no longer need. Familiarizing yourself with your rights as a borrower is also an important step. For example, credit card companies can't harass you for payments, and there are specific rules they must follow. In severe cases, you may consider debt settlement or consolidation. However, understand potential consequences such as facing fees or impacts on your credit score before going down this route. Once you've addressed the immediate problem, make a plan to prevent similar situations in the future. This might involve building an emergency fund, revising your budget, or seeking financial education. The most important step is to act quickly and not let the problem grow. Credit card companies are often more willing to work with customers who proactively seek solutions before their accounts become seriously delinquent. There's a lot of confusion about how many is too many or how few is good for credit health. The number of credit cards you should have isn't a one-size-fits-all. It really depends on your financial situation, spending habits, and your ability to manage credit. Having more cards increases your total available credit, which can be beneficial, as long as you don't proportionally increase your debt. Another consideration is payment management, or your ability to reliably pay off your balances on time. More cards means more due date statements to keep track of. Different cards can also offer different benefits. Some might have great travel rewards, while others might have cash back on groceries or gas. Having multiple cards can maximize rewards, but only if you manage them well. Credit history should also be considered. Each time you apply for a credit card, it can temporarily ding your credit score. However, having longer credit history can positively impact your score. Some cards with the best rewards have annual fees, so it's important to make sure that the benefits outweigh these costs. Having more than one credit card can be useful in emergencies, especially if one is lost, stolen, or compromised. Having a mix of different kinds of credit, like credit cards, car loans, and mortgage, can positively impact your credit score. A practical approach might be to start with 1 or 2 cards and see how well you manage them. If you're comfortable and disciplined in using them responsibly, adding another card for specific purchases might make sense. It's all about finding a balance that works for you financially, and then responsibly managing your credit. Remember, it's not just about the number of cards, but how you use them that really matters. It may seem basic, but knowing the difference is fundamental to understanding how each affects your credits. The first big difference is where the money for each comes from. When you use a credit card, you're borrowing money from a credit card issuer up to a certain limit. This is essentially a short-term loan you're expected to repay. A debit card, on the other hand, is linked directly to your bank account. When you use it, money is immediately and directly withdrawn from your account to pay for the transaction. Another significant difference is which card affects your credit score. Responsible use of a credit card can help you build a positive credit history and improve your credit score. Debit card usage doesn't affect your credit score, as it's essentially like using cash. Let's talk about overdraft and debt potential. If not managed properly, it's easy to accumulate debt on a credit card due to the ability to spend money that you don't have. Whereas with debit cards, you can only spend what's in your account. But what about interest and fees we hear so much about? With credit cards, you'll be charged interest on your balance if you don't pay it off in full each month. Plus, there's other possible fees like the ones we discussed earlier. With debit cards, there's no interest charges, but there can be fees for overdrafts, insufficient funds, or using an ATM outside of your bank's network. Now let's talk about the real fun stuff, rewards and benefits. Many credit cards offer rewards like cashback, points, miles, and may come with additional benefits like travel insurance, extended warranties, or purchase protection. Rewards tend to frankly be less common with debit cards. Credit cards also offer stronger protection against fraud. You're generally not responsible for unauthorized transactions if you report them promptly. While there is some fraud protection with debit cards, the fact that funds are drawn directly from your bank account can mean you do lose access to your money until the issue is resolved. So essentially, credit cards offer the ability to borrow, potentially earn rewards, and build credit, but they come with the risk of interest and accruing debt. Debit cards, on the other hand, are more like digital cash, with less risk of debt, but also fewer benefits and rewards. So how do I manage my budget and pay my credit card each month? If you do the next steps in your financial journey right, it can actually keep you out of the debt trap permanently. Setting up a consistent budget will keep the most money in your pocket, and it's actually a lot harder than it seems, so I made a whole video to break it down.